Welcome back to another episode of the Learn to Swing Trade the Stock Market podcast. I am your host, Brian Montez, and today we're going to dive into a very timely topic that I feel is really important, especially if you're new to swing trading and if you didn't trade during the last Trump administration. And I know this is on the minds of many, many traders right now, and that's why I wanted to record this episode and just tell you what I think you need to be looking out for, what we need to be looking out for, and what it might be like to swing trade the stock market under a Trump administration. Now, let's be clear. This episode isn't about politics. I would have recorded the same podcast had the Harris administration won, because the markets do respond differently between Republicans and Democrats. That's just a fact, right? Policies drive the markets to do different things. So we're going to focus on how different administrations can influence the stock market, especially for swing traders. And history has shown us that markets can respond differently to different policy directions, and understanding these patterns can help you make more informed trading decisions. So today we're going to explore three key areas that swing traders should watch closely under this new administration. All right, let's jump in. So first, part of the reason why I wanted to record this episode is because I was trading during the last Trump administration. And so I've got that real life experience of what it's like to trade during a Trump administration. So I'm bringing, some real life examples and real experience to this, because if you're brand new to swing trading the stock market or trading in general, whatever you're trying to accomplish, it's definitely learning from what happened last time may benefit you as we move forward. So one of the first things that we may see, and we saw in the previous administration, was market volatility and policy announcements that come out of nowhere. So in the last administration, that's when Twitter existed. It wasn't X yet. And until Trump got banned from Twitter, he was using Twitter as his way to communicate with the American public. And so it was very tough, depending on what you were trading, because if he tweeted something that, say he got upset with Ford because they were outsourcing production to Mexico, and he tweets that he's going to apply tariffs to Ford's trucks coming in from the Mexico plant. And then, next day we wake up and Ford's down, 10, 12, 15%, 20%. So in the last administration, some of the challenges we had was just increased headline risk, because you just never knew what type of tweet was going to come out and what type of policy announcement was going to get floated out there that we weren't expecting to see. So you're going to want to keep an eye on this market volatility, and especially, be able to respond to unexpected policy announcements or changes. Now, things very well could be a little calmer this go around. But one thing we know from the past is that, Trump's administration has been known for making very bold policy moves. And sometimes those very bold policy moves come without little to no warning. So whether it's a new trade policy, a change in tax regulations, or some geopolitical tension that he's addressing, these announcements can trigger sudden market swings. So again, going back to the headline risk conversation that you get with this administration. So what does this mean for you as a swing trader? Well, volatility can be a double-edged sword, as you probably already know. Right? On one hand, it presents opportunities for quick gains if you're on the right side of the trade. On the other hand, it can increase the risk of sharp price reversals that are just going to catch you off guard. And we know that with headline risk, if something happens and there's a headline risk made after hours and we wake up the next morning and that stock is down 20, 30%, we know that our stop loss isn't going to work. We know that when the market opens up, it's going to blow right past that stop loss. So you've really got to take a look at what companies you're trading and do some additional analysis to determine, hey, is there some additional headline risk? Is this potentially a segment or a company that the administration could target? And if so, you're going to want to think about that as you look at your trade opportunities. So what can you do as a swing trader to deal with this? Well, in addition to looking closer at the companies to see if you think they could be on the radar of the Trump administration, the other thing you need to do is pay attention to the news cycle, right? So I would consider setting up alerts for major policy announcements. You've got to keep your finger on the pulse of what's happening in DC so that you can try and anticipate potential headline risk that may be happening with something that's in your swing trade portfolio. The other thing you can do is you can increase your cash positions, right? If you notice the market starting to become highly erratic, don't be afraid to increase your cash positions. Cash is a position. For me personally, I saw this year's election as an earnings level event, and therefore, I went into all cash just before Tuesday, November 5th. I just did not want to be in the market. Yes, I probably lost out on some opportunity from the rally that's occurred, but in the end, had things gone the opposite direction, had the market responded negatively to a Trump win, we could have seen the sell-off be equally as large as the buy-up was. So for me personally, being on the sidelines in cash just fit my risk profile. So, I'm okay with the fact that I missed out on some opportunity. So if we do see the market becoming highly erratic, it's okay to start going back into cash. Sitting on the sidelines during periods of extreme volatility can protect your capital from unnecessary risk. What's the second thing you need to be thinking about in this new administration? Well, sector specific moves. And again, this falls back to policy driven trends and decisions. The second key area for you to focus on is how specific sectors might respond to Trump's policy preferences. During his previous administration, we saw certain sectors like energy, defense, and financials performing very well, while other sectors like renewable energy faced headwinds due to deregulation and some policy shifts. What do I think is going to happen in this upcoming administration? Well, the energy sector, for one, the oil and gas sector might very well get a boost. We know that the Trump administration wants to open up drilling in the US, right? They want to become energy independent. So you very well may see energy stocks such as Exxon and Oxy and some of the other oil and gas companies and oil and gas adjacent companies, right? The companies that build infrastructure for the oil and gas industry. You might see some of those sectors really start to take a lift over the next couple of years. Where you may see on the flip side of that is renewable energy. You may see renewable energy come down. You may see that sector start to take a beating because the chances of the Trump administration continuing to subsidize wind energy and solar is probably pretty low. So you might see some of the renewable energy stocks take a hit over the next couple of years simply because they're no longer going to be as subsidized as they are today. With the defense stocks, yes, we saw the defense stocks get a lift during the first Trump administration. In this particular go around, my personal opinion is that the defense stocks may not fare as well as they did before, simply because he is looking to de-escalate tensions. He is looking to, get an end to the Russia-Ukraine war. He is looking to have, Israel finish up its offense in Gaza. And so if Trump is successful, if the administration is successful in de-escalating global tensions, we could see some of those defense stocks start to stall a little bit because we're not going to be shipping as much hardware and military stuff overseas as we currently are. So it'll be very interesting to see what the defense sector does under this new administration. Last but not least are the financials. Where I personally think financials are going to really start to perform well over this next few years is fintech, financial technology companies. I think some of the regulation that's going to come out and policy decisions that will come out from the Trump administration towards financials and fintech are going to be very beneficial to that sector. And I think we'll start to see growth in that sector, and we'll see some of those stocks starting to perform very well. I know just today, the day I'm recording this podcast episode on November 11th, fintechs had a great day today, from your Squares to your Affirms, right? Those fintech companies performed very well today. So we definitely could see that as we move forward through this next 2 to 4 years. So what does all this mean for you as the brand new swing trader? Well, policy-driven trends can create opportunities for sector rotation, which is something that we definitely have a high probability of seeing, right? We may see money start to rotate out of the NASDAQ, out of tech, and into other laggard industries that have not been performing as well. Energy being one of them. So if you can identify the shifts, you can position yourself to benefit from sector-specific momentum. So for example, energy stocks, right? Energy stocks have been a laggard as we come to a close of 2024. I personally have put energy stocks on my do not trade list this year because I've just not been able to successfully trade energy. But Trump historically has been very supportive of the oil and gas industry. So if we see similar policies this time around energy, we could see those energy stocks get a boost, especially the traditional fossil fuel companies. And again, you also might see some of the Energy adjacent companies do well, companies that build infrastructure for oil and gas companies. Defense and infrastructure. So typically, increased government spending on defense or infrastructure projects can be a tailwind for companies in those sectors. But again, while he might they might make sure there's enough funding for our military, I'm not sold that defense is going to benefit as much as they did last go around if he is truly successful in de-escalating a lot of these global issues right now. So we'll just have to wait and see how defense, what the policies and how the Trump administration navigates all of the conflicts and whether or not he is successful in de-escalating some of them or if he's not successful. If he's not successful, the defense sector could continue to do well as we continue to ship hardware overseas. And third, of course, is the financial sector. Deregulation, if there is any more deregulation in the financial sector, right, a loosening of some of the SEC rules, less regulatory oversight, that will benefit financial stocks, especially banks and credit unions, right? And fintech will also catch a tailwind from that because so many banks partner with fintechs to provide some of those financial technology products to their consumers. So watch for opportunities in regional banks, financial service firms, and fintech because their margins might improve if there's a little bit less regulatory pressure on them. Now, whether or not you think there should be more regulatory pressure on banks, less regulatory pressure, that's, we're not here to debate that today. We're just discussing whether or not a reduction in regulatory pressure will help the banks on their margins. So as a swing trader, focus on sector rotation strategies. Keep an eye on which industries are moving in response to policy shifts. And you can use tools like the Relative Strength Index, RSI, and sector ETFs to identify which sectors are gaining momentum. I love to, in the sector ETFs, it's great to identify what the 10 to 15 top holdings are in each sector ETF and create a watch list for each sector ETF so that you can easily get a snapshot each day of what that particular sector is doing to see whether or not any rotation is happening in or out of that particular sector. Number 3, the interest rate and inflation outlook. The third factor that we have to consider is the outlook for interest rates and inflation. During the previous time in office, Trump frequently criticized the Federal Reserve, butted heads with them, and he was upset because he felt they kept interest rates too high and advocated for a lower rate environment. But although we really couldn't get much lower rate because we were, pretty much toward the bottom, they didn't start raising rates until recently. So if we see similar rhetoric or policies coming from this administration, which we've already started to see, right? Even before Trump won the election, he was pressing on the Federal Reserve to lower rates. So it's already started. And in the FOMC meeting last week, Powell was directly asked by a reporter whether or not he would step down if he was asked to do so, and he said no, that basically the president could not fire him, although the president did appoint him. So it'll be very interesting to see what happens between Trump administration and the Federal Reserve and whether or not they butt heads as we go into this next administration. And, whether or not it influences the Fed's approach to rate hikes or cuts. Of course, Powell is saying that he, makes decisions independently and does not take into account what the stock market is doing or what the president wants per se. Whether or not that's completely true is a different conversation, but of course that is what is said publicly. So we'll need to watch for what type of friction gets created between the Trump administration and the Federal Reserve. So how can this affect your swing trading strategy? Well, interest rates, they have a significant impact on stock prices, especially on growth stocks versus value stocks. Now, as of this recording, we've had 2 rate cuts so far since the Fed started raising rates, right? Last go around, they reduced the interest rate by half a basis point. And last week, they reduced it by a quarter basis point. So they are starting to pull back interest rates just a little bit. But here's a few ways this might play out. Growth versus value stocks in a low interest rate environment. Growth stocks tend to benefit because their future earnings are worth more in today's dollars. Then on the other hand, higher rates could favor value stocks, especially those with strong cash flow and good dividends. So if the Trump administration pushes for lower rates, which we know they're going to, keep an eye on the high growth sectors like tech. So this might give a boost to tech if Trump is successful in getting Powell to further reduce interest rates. Then the other thing you got to watch out for is the impact on the dollar. Lower interest rates can weaken the US dollar, which can benefit for commodities like gold and silver, as well as export-oriented companies. To the opposite, if rates stay high, it could strengthen the dollar, which may hurt those same sectors. So if we see the US dollar, weaken, we can look at commodities like gold and silver for some opportunity, right? We could trade the ETF GLD and the ETF SLV, right? There's ETFs we can trade that, are gold and silver based. So that could create some opportunity to trade those to the upside. Bond markets. Watch the bond market as an indicator of where interest rates might be heading. And we always watch the bond market regardless of who's in office. The 10-year yield is specifically the one bond that I like to watch. The 10-year yield is the one that I make sure I have on my trading platform, on my charts, and I watch that. I want to see if the 10-year yield is climbing up, because typically when your yield, when the 10-year starts to climb, that puts downward pressure on the stock market. When the 10-year is dropping, typically that is a boost to the stock market. So we have to watch the 10-year yield as well as any other bond market moves you want to watch to see what's happening, because it could signal expectations of lower rates, which will drive money into riskier assets like stocks. So you really do need to watch what's happening with the bond market. And like I said, I specifically like to watch the 10-year yield. So here's some practical trading tips for you, especially if you're new and this is your first go around with this upcoming administration. First, diversify your watch list, right? Make sure you have things coming on your watch list that are not just tech oriented, right? Start to look for opportunities in sectors that might be getting a rotation. So this way you can build watch lists in other categories. Also, monitor economic indicators, right? Keep an eye on economic reports like the Consumer Price Index and the Producer Price Index, which is CPI and PPI, which regardless of administrations, you should be doing this anyway. You should be watching what the CPI gives us and the PPI, because those potentially are news events that can drive the market one way or another. So these are news events that you should be watching regardless of administration. But these two indexes can give you insights into inflation trends, which ultimately might influence Fed policy. Also, use your economic calendar. If you use TradeView, which is the charting platform I use, there's a wonderful economic calendar that is built into the software. Being aware of when major Fed announcements or economic data releases are scheduled, it's going to help you avoid getting caught in unexpected market swings. Now, we can't sit out all the time, right? There's news every single day, and if we say, well, I can't trade because this news is coming up, or this news, then you're probably never going to trade. You have to pick and choose and understand which news events really, really, really could move the market and which news events are nothing burgers. This way you understand, okay, that news event, that's not going to cause too much heartburn. I could be in the market, right? You need to understand which news events are really going to make moves in the market. And it doesn't necessarily mean that you can't be in the market when those news events are released, but you need to be aware of where your stops are and how you're trading to make sure that you don't get a bigger loss than anticipated. All right, let's go ahead and wrap this up. So swing trading under a Trump administration, it might present some unique opportunities and some challenges. It may not. We'll have to wait and see. But it doesn't, regardless, you still need to pay close attention to market volatility, watch for sector-specific trends, and you need to watch the interest rates and the inflation outlook so that you can better navigate the market's ups and downs and, try and be ready for what might be coming. And remember, the key to successful swing trading in any market environment is to stay disciplined, stick to your trading plan, and always manage your risk, regardless of who's in office or what's going on with Congress or any political stuff. You still always have to stick to your trading plan, manage your risk. Use the tools and strategies that we discussed today to help you better position yourself for success no matter how the market reacts to this administration. Well, I do hope that you have found this episode helpful. And if you did, don't forget to subscribe, leave a review. I'd love 5 stars. That'd be awesome. And share it with some fellow traders. And as always, stay disciplined, stay focused, happy trading, and we will see you next week on the Learn to Swing Trade the Stock Market podcast.